Look, let me paint a picture. It's Sunday night. You're sitting at the kitchen table, mortgage statement open. You see that big number at the top, $612,000, $485,000, $328,000, whatever yours is. And then you scroll down and you see the payment breakdown. Principal, $742. Interest, $2,118. And you just sit there like, wait, hold on. I paid over $2,800 this month and barely anything went toward my house? And here's the worst part. Nobody warned you. The bank didn't warn you. The realtor didn't warn you. Your parents probably didn't even understand it themselves. Because if they had, you would have asked a very different question before signing that mortgage. How fast can I get out of this thing? If that moment feels painfully familiar, yeah, this video is for you. My name is Nate, and I spend way too much time thinking about money psychology, debt traps, and why normal people stay broke even when they're doing everything right. If you're someone who has a mortgage, feels like the balance barely moves, and secretly worries you'll still be paying this thing when your kids are grown, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Because today, we're talking about the ugly truth about mortgage interest, how banks actually make their money, and most importantly, how to pay your mortgage off years early without destroying your life in the process. And fair warning, once you understand this, you cannot unsee it. Here's the thing. We're told a mortgage is good debt. We're told it's normal. Everyone has one. You'll pay it off eventually. Don't worry, inflation will take care of it. But here's what most people don't realize. A mortgage is not designed to be fair. It's designed to be profitable, extremely profitable. Let me show you what I mean. Let's say you have a $500,000 mortgage, 30-year term, 5.5% interest, which is by historical standards is actually normal. Your monthly payment is roughly $2,840. Now here's the part no one talks about. Over 30 years, you don't pay $500,000. You pay $1,022,000. That means $500,000 goes to house. $522,000 goes to interest. You literally buy the same house twice. And according to data from the Consumer Financial Protection Bureau and Federal Reserve, most homeowners never even make it to the last year of their mortgage. They refinance, reset the clock, or move, which means the bank almost always gets the most profitable years of the loan. This is where it gets really interesting. Mortgage interest uses something called amortization. Sounds boring. It's not. Amortization means the bank collects most of its interest up front. So in the first 5 to 10 years, 70 to 85% of your payment is interest. Almost nothing touches the principal. On a $500,000 mortgage, after 5 years, you might still owe $460,000. After 10 years, maybe $410,000. That's a decade of payments and barely any progress. And this is why people feel trapped, discouraged, like what's the point? That feeling isn't accidental, it's psychological design. Here's what most people don't realize. Humans need visible progress. When progress feels slow, motivation drops, discipline collapses, people stop trying. That's why banks love long mortgages, because once you emotionally accept, this is just how it is, you stop questioning the system. And that's exactly when you stay stuck. Now you might be thinking, Nate, isn't it smarter to invest instead of paying off the mortgage? Great question, and here's the honest answer. Sometimes yes, most of the time no. Here's why. People assume, I'll invest the difference. Markets average 8 to 10%. Mortgage is only 5 to 6%. But behavior matters more than math. According to Dalbar studies, the average investor earns 2 to 4%, not 10%. Why? Panic selling, lifestyle inflation, inconsistent investing. Meanwhile, paying off your mortgage early gives you a guaranteed risk-free return equal to your interest rate. No volatility, no emotions, no headlines. That certainty is powerful. Let me tell you a story. A couple I know, average income, nothing fancy. They had a $380,000 mortgage, 30 years, normal jobs, 2 kids. Instead of upgrading cars, vacations, and lifestyle every raise, they added $400 a month to principal. That's it. Result? They paid off their mortgage 11 years early, saved over $170,000 in interest. And here's the part nobody expects. Once the mortgage was gone, their life changed instantly. Stress dropped, options exploded, investing became easier and calmer. This is why I get frustrated when people dismiss early payoff. Here's a simple one. Switch from monthly to bi-weekly payments. You make 26 half payments per year, which equals 13 full payments instead of 12. That alone can shave 4 to 6 years off a 30-year mortgage. No pain, no lifestyle change, just math. Here's what most people don't realize. A $200 principal payment today is worth more than $1,000 later. Why? Because it eliminates future interest. So tax refunds, bonuses, side hustle income, raises. Instead of upgrading your lifestyle, attack the principal. This is how momentum builds. If you do nothing else, remember this. Any extra dollar paid in the first 10 years is 3 to 4 times more powerful than later payments. This is where banks make their money, which means this is where you fight back. Refinancing into 20-year, 15-year. Yes, the payment is higher, but interest drops dramatically, forced discipline kicks in, and payoff becomes inevitable. This works best after you stabilize cash flow. Here's the mindset shift nobody talks about. The goal isn't to own a house. The goal is to own your time. A paid-off house lowers your survival number, reduces fear, increases flexibility, makes investing easier and calmer. According to The Psychology of Money by Morgan Housel, financial success isn't about maximizing returns, it's about staying in the game long enough to win. And nothing keeps you in the game like low fixed expenses. Look, the bank is not evil. The system is just optimized for profit. But once you understand the rules, you can choose differently. You don't need a massive income, perfect timing, or extreme sacrifice. You need awareness, consistency, and a long-term plan. Because paying off your mortgage early isn't about being financially optimal, it's about being financially free. If this video helped you see your mortgage differently, hit that thumbs up. It tells YouTube to show this to more people who need it. And if you want more real, honest money talk, not hype, not gurus, make sure you're subscribed. Because once you understand how money actually works, you stop playing defense and you start taking control. I'll see you in the next one.